Hi, this is Colton Carnival with Fast Graphs. So in this video, I wanted to explain the differences between the forecasting calculators and some numbers that you may get when using these calculators. So as you can see, we have 5 calculators that all have different types of estimates associated with them. The first 2 calculators, the estimates and the normal multiple, have the same data in terms of estimates. So 492, 495 right there. Then we would see 492 and 495 right there. Now, the differences between them is the line, the valuation line that is drawn. So for the estimates chart, what we do is we draw our, normal valuation formula that is seen on the historical graph. It's the same formula that draws the orange line for the historical graph. So that's what's calculating this orange line right here based off of the growth rate of the company, based off of these specific estimates given out by these analysts. The normal multiple then, once again, uses the same estimates that are given by these analysts, but instead of using the orange line formulas that we have, we use the normal PE ratios that have been in the past. So this would be, the 15-year normal multiple. This would be the 3-year normal multiple. That's all changing the valuation line of this, which all changes the numbers. So this is right now at a 15.55, which changes the total annualized rate of return in this case to 10.37%. If this was at the 7-year at 16.63, now it's at a higher rate of return because the valuation line is higher. This is just to see what the market has appraised it in the past. And you can also use this bar right here, or this box, to see in the past how valuation has gone. So valuation is kind of lowered in the past 12 years, and then it started to rise again and then kind of tapered off. So the market tends to, just looking at this, the market tends to value this anywhere between a 14 and a 16 PE ratio. That could be considered fair value, whereas maybe something like a 20 or a 19 in this case, this really isn't realistic to think that the stock could go to this price. Now, we've also got the long-term growth, which is a completely different set of estimates. What this is it takes the last actual and grows the last actual by the long-term growth rate estimate, which in this case is 8.38%. So once again, this is a completely separate set of estimates, where instead of estimating the individual years of estimates like they did on these two, they just gave a growth rate estimate. So we take the last actual, grow it by 8.38, then we take that estimate, grow it 8.38%, then take that estimate, grow it 8.38%, so on, so on, so on. And that's how this is drawn. So this is a different set of estimates, which can provide a different view of what this company is going to do. So based off of these growth rate estimates growing from the last actual, this is where the numbers would be. So instead of being in 2022, it would be expected to be $4.22 in terms of earnings, where in 2022 over here, the individual estimate is $4.92. So there's a big difference there. But once again, it's a different set of analysts and a different group of estimates being used for this. So you can kind of get a different picture of what analysts are expecting this company to do. Then we've got the historical compound annual growth rate, which is like the normal multiple in relations to the estimates chart, but for the long-term growth rate chart. So what I mean by that is you can then plot historical long-term growth rates and grow those by, each year. So this works exactly like the long-term growth rate chart in terms of how the numbers are calculated, but instead of having the actual long-term growth rate estimate, it uses the historical compound annual growth rates that you can change and input. Now, once again, this box down here can be used to see what growth rates have been in the past. And, they're anywhere from an average, I would say, of just looking at these numbers, maybe 6 to 7%. And then, we've got some higher numbers here, which I wouldn't say to use these ones because it's not easy to grow at 19.06% per year. But a number maybe like the 5-year around 7 or 6, just looking at those numbers, would be a good average. And then finally, we've got the custom chart, which this allows you to enter custom growth rates. You can switch between the long-term growth rate and adding the individual estimates with the long-term growth rate here. You can change some inputs over here and change, the PE ratio to be whatever you want. If you wanted to see it at a 20 PE ratio or even see it at a 12, what your possible rates of return could be. So that's essentially how the forecasting calculators work and the small differences between them.